I think volatility could come back very soon, because now if you look at all the major stock indices here, they're in a way overbought territory. I think it's, the overbought level is at its highest in the past 10 years. So I think normally when this happens, people tend to want to take some profits. But then if you're looking into the longer term to 6 to 12 months, then I would say that, the positive elements for the market are still there.
I was looking at some research that looked at two previous spikes in the Chinese market over the last 20 years. And its conclusions were, well, there wasn't really a conclusion, i.e. 2/3 of the time we go down after a year, down about 11%, but a third of the time we go up another 60% as well. Which direction are you betting on, sir?
Yeah, I would say that the general trend is going up, but then, for another bubble to happen, some necessary conditions has to be in place. For example, we need to see credit expansion, especially domestic credit expansion, especially credit expansion relative to broad money supply. So what happened, especially in 2015, even though the economy was doing very badly, back then, because of the financial disintegration, so you're seeing credits flowing into the real economy via non-bank channels. So I think after that, the CSRC and the CBRC actually reined in many of these non-bank channels, and therefore domestic credits can only once again be passed on via the banking channel. So I think, if you really want to see a 5,000, maybe 6,000 stock bubble again in the Chinese market, you really need to get the domestic credits flowing before you can see that.
Are there political oscillations that could drag down these markets, both the mainland markets and the Hong Kong markets? Of course, we've seen a lot of the events in Hong Kong and concerns that international investors have as well. And there is always the threat continuing of trans-Pacific trade wars as well. Do either of these major issues actually affect the psyche of investors at the moment?
Yeah, I would say so. If you look at what happened in the past couple of months, the U.S. market has been doing very, very well. The 17% year-to-date gain in the Chinese market happened in the past 4 or 5 days. So I think most of this year's gain is actually very concentrated in just a few days. And the reason why the Chinese market has been struggling was because of the sort of intensifying competition and conflicts between the U.S. and China. And I think, the situation could get worse, as we head into the November U.S. election. This morning we heard, some proposal about undermining the Hong Kong dollar peg, and that would be really undermining the cornerstone of Hong Kong's economy. So, the headlines could get very negative, and that could sort of add to the volatility in the markets here.
What about the data? I mean, a huge improvement in the data as well. But our viewers are looking now, are wondering which is the key data to look at. Of course, we're all looking at things like initial jobless claims in the States and the ISMs and the PMIs. What about over in China at the moment? What are the key pieces of information that our viewers need in order to make a calculated decision?
Yeah, year-on-year growth on domestic credit, and also year-on-year growth on broad money supply. And I think those are probably the most important leading indicator for the Chinese economy and for the Chinese market. So far, we've seen total system financing is up 12%. We haven't seen double-digit gain system financing for a long time. And also, broad money supply M2 is up year-on-year 12% as well. So we haven't seen that in more than 5 years. So I think all of those numbers are looking good for the economy and also for the markets here. Other than that, we do see some improvement in the PMI, ISM, and all that. But because those are really sentiment surveys, I wouldn't put too much weight on those factors.